Well, good morning and welcome to the Trigger Charts pre-market rundown for Friday, July 15th, 2022. I'm running a little bit late today. I'm sorry, but I am here in the hot seat. I hope everybody's doing well. The reality is that it's been a bit of a tough sledding right now, as we all know, and that is because we have a lot of things that are in the cross currents. One being, and primarily being, the fact, well, that the Fed has its boot on the neck of the markets. What they've done is essentially trying to force a recession. So what's happening is that we're seeing that prices are adjusting, volatility is significant, and as we go through the process of having a higher interest rate environment with a higher dollar and looking at the rest of the world and what's going on there's a lot of confusion, problems, and, well, it's just everybody's just generally pissed off. So what's going on? Well, we'll talk about in a second. Before we do that, let's talk about the important disclosures that we have to talk about. Investing involves substantial risk. Past performance is not a guarantee of future results, and a loss of original capital may occur. And of course, please consider everything that we talk about today for educational purposes only. Before we go any further, I want to mention something because I've been telling you about this for a while now. And one of the big things is that we're making a transition from the TradeStation trading app store. And I just 2 minutes ago, why I was late, was responding to an email talking about some of the next steps that we're taking. It's pretty cool. We are going to be working on an upgrade and it's going to be really nice because essentially what you're getting now is going to be enhanced on this new platform that we have. So stick around. Do not, as I mentioned this before, do not cancel the TradeStation trading app store platform plugins that you have, indicators, because you won't be able to get them back. And until we get this transition, which is going to happen, and I'm going to let you know, and it's all good. September is the time that you're going to have this happen. We're going to probably start with a few people. And by the way, if you are interested in being we'll call it a first run user for some of the new products, if you want to test it out for us and make sure everything's working, which it will, but if you want to do that, just send me an email to support@TriggerCharts.com and say, hey, I want to beta test the new platform. And we'll get you set up on that. It's pretty cool. It's a lot of really interesting things that you're going to get there. And what we did was actually expand the offering. So I'm pretty happy about that. Okay, let's see here. Chat is disabled. Yeah, if any... Yeah, I know. It says 10-day free trial. I know. I'll get rid of that. So some people are pushing the chat's not working. Do you see chat's not working? Somebody said that? Can somebody type in? Yeah, I'll type it here just to see. Can you type it in right there and see if it's working? Huh. Wonder what that's about. Is there something going on here? Let's see if I can. I don't. Oh, we'll fix it next time. I don't know what is going on there. Let's see what it says here. I don't know why. All right. I don't know why chat is disabled. I really don't understand. Chat is really. I didn't change anything. Maybe there's some new, you know how they keep updating programs, so we'll see what's going on with that. Okay, use the Q&A. That's fine. We'll leave that. I prefer that anyway. We'll dismiss a few of these. Okay. So yeah, send me an email, support@TriggerCharts.com. Can you even see my chat, by the way? The last question on chat. Well, it doesn't matter. Okay. It doesn't really matter. Doesn't matter. You can see my chat. Huh. Weird. Let's see what it says. Oh, here we go. Wait, here I see it right here. Try that now. Try to see chat. Hello. I think I fixed it. There we go. Yep. I don't know how that happened, but there you go. All right, where are we? Let's talk about the future. Let's talk about the futures, where we are right now. Well, the futures bounced on the retail sales numbers and the whole freak out event of yesterday and the last couple of days where, you know what, we're not having a 75 rate increase, but we're having a 100 basis point rate increase. And that is something that was going to be predicated by how hot the retail sales numbers came in today, some of the manufacturing numbers, and they came in okay. They didn't come in too hot, but they didn't come down either. So the consumer is still resilient right now. The themes that we have to talk about, I mean, I don't think there's anybody that is, going to argue with this, but we went from, this is kind of important, went from inflation fears and where we had pricing, where we saw that commodities were moving up, and we saw that the dollar continued to move up, which it did. And here's the dollar right here, by the way. Where we saw that interest rates, of course, are going to be a concern. And then all of a sudden now we're breaking into a recession concept moving forward. In other words, pricing various instruments on whether it's futures on commodities or on market indices, whether it's hards or softs, whether it's things like bond yields or even currencies. We were all, not all, I mean, that was the playbook, right? The playbook was inflation fears and let's price out things for inflationary times. And the Fed came in and now things changed. This is why right here, the recession is why we saw the major move on equities. The fact is that when you enter into a recession, different than inflationary times where things are growing and they're growing, but you know what? They still, if left unchecked, what would happen there is that you would see the continuation of that. Now, all of a sudden, the Fed comes in and says, you know what? Not so fast, Buster. We're going to start really cracking down on the overall levels here. And if we have to, we will force the economy into recession. Uh-oh. There you go. What does that mean? Well, that means lower earnings on stocks moving forwards. Consumers won't have the ability to spend as much money as they have been doing. We'll have a recoil and a retractment from the spending that's going on, and everything just goes to hell in a handbasket. So now we have to enter in, as we call it, the recession playbook right here, right? This recession playbook that we're looking at. And what does that mean? Well, we're going to see more volatility. We're going to see concern about banks. We're going to see possibility of real estate starting to slow down, higher unemployment, all the things, well, not all the things, but a lot of things that the Fed wants to see. The Fed wants us to have our economy slow down. So that's what's happening. And so we have to switch our mindset for a moment here into the idea that there is a change in the dynamic that's going on. Now, we may see the fact that we're all happy. We're like, oh, but wait a minute, Horowitz, look at these. Oh, man, we got a great day here. It's off to the races again. I mean, gold is still lagging. We're talking about 5 weeks down on that. Bitcoin coming back, being kind of resilient right now. This has been the biggest issue right here. We're talking about the dollar. I mean, we went from, in July, let's just mark it right here, July right here, right? From 105 all the way to 108 in nonstop territory. Listen, we called it long on the dollar right about here at about 102.5. You see that? All the way up. Recently, the dollar, as we show in our altimeter, in our market profile algorithm, we got a stop out, or at least a take profit. A profit watch, we call it, the orange, right? The orange. And that is showing that there is some tendency that maybe this is going to start to reverse down. And where do we go? Well, there's definitely some support at 107, a little bit at 106, not a lot there. I mean, truthfully, the biggest support probably right now is at about 104. This whole ride, I think, has to be reversed. Now, it's not going to be immediate, but if it does, this is going to be beautiful. And there's a lot of people talking about we've reached peak inflation, that we have reached a point that, the dollar maybe is detrimental to the rest of the world. And, the rest of the world is lagging us in a lot of ways. Japan, for example, is not going to raise interest rates, and that's not going to do it. Their inflation is just over 2%, and their people over there, Corona, will have nothing of it. In Europe, I don't think they have the ability to raise rates, even though they have to. The fact of the matter is the euro now is at parity. It's at parity. The yen is at 137. It's absurd how strong the dollar is. That's good for some things, like if you want to go traveling, but where are you going anyway? You can't go to Japan. Do you want to go to Germany? In the midst of all the things that are going on there, the high costs that are going on and problems that we're having with Ukraine? No. But one of the things that's happening, I think I really noticed, and I want you to pay attention to, and I'm going to move on from here right now. But basically, I think we're talking ourselves into a recession, basically penguin style. This week on the Disciplined Investor Podcast, I'm going to be talking about that. We're going to be talking about ostriches and penguins. Which one are you, if either? But penguins, what do I mean by that? You ever see penguins lining up on the iceberg or on the edge of an area on an island and there's water in front of them? They all just standing there looking, just waiting. What are they waiting for? They're waiting for the first one to go diving into the water. Once the first one dives into the water, what happens? Everybody else in the pool, right? Isn't that what happens? So what's happening right now is that we are seeing that all of a sudden, analysts, economists are starting to say, hey, wait a minute. Maybe we need to mark down the future. Maybe we need to look at what's going on right now, and maybe, just maybe, our 4,600 S&P 500 end-of-year call is a little high. Now, what's happening is they're going to correct. They're going to correct their numbers on earnings. They're going to correct their numbers on the outlook for GDP, inflation, the economy, the indices. And what they're going to do is they're going to overcorrect. This is what they do. It's just what they do. You have to go with me here. And when they overcorrect is where the opportunities will come in, because now already they're looking at earnings of about $250 a share on the S&P 500, dropping to 225. Are they going to take it to 200? Now, when you have 200 on the S&P 500 at 15 multiple, that's only a $3,000 price tag on the S&P 500. That's about 800 points down from where we are now. Too much? Possibly. 15 multiple? The right one? I don't know. Certain recessions, you see it down to 8. You know, you take a 200 times 8, you're talking about 1,600, a 50% drop on the S&P. Is that going to happen? I don't see how that's going to happen. We don't have a real economic problem. We have ourselves talking ourselves into a recession because the Fed wants us to do that. They want us to do their dirty work. But I'll tell you something here right now, and you can mark me on this, okay? If, in fact, the Fed does come out and they go and they, in fact, raise 75 basis points and then another 50 basis points, it's only going to be a matter of time. They got to start reversing that. Already what we've seen is a massive slowdown in economic activity. The banks are freaking out. We saw Goldman Sachs, Morgan Stanley, Citigroup, Wells Fargo, talking about 25% drop in their overall earnings and revenues from a year ago already. Now, okay, let's admit there was some excess in there due to all the stimulus. All right, I'll go with that. Fact of the matter is, though, that things are slowing down. Beige book that we saw this week, right? The beige book, strength in most regions. Still, this was out yesterday, higher prices in most regions. So what we're seeing is the continuation of good economic activity, but yet at the same time, we're seeing that higher prices are prevalent. That will break. The best cure for higher prices, you know this one, is higher prices. The best cure for higher prices is higher prices. And what we're going to see is things change. Now, what happened, for example, with oil prices? Back down to 92 yesterday, up to 97 again yet today. What's going to happen with produce prices? Have you seen what's going on with chicken? Have you seen what's going on with produce? Back down significantly. Steaks. So there is this reversal that is going on with commodities already because we've gone from an inflationary mindset into a recessionary mindset. Now, earnings. Banks that come out, they're the first ones to come out. We saw that this week. JP Morgan, Jamie Dimon was relatively, I would say, negative. At best lukewarm, but negative. Looking at this hurricane that he's been talking about, getting closer, but not here yet. Earnings down 35% from a year ago on some of these companies. I think they were down about 28, 29%. But the big issue right now is that banks are starting to reverse what they just recently did. And that was this. This is important. They're starting to build their loan loss reserves again. And what happened is that they dumped them because after the major set-aside with regard to the pandemic, so the good news is that when we look at what's happening right now, I mean, I think what's happening right now is that there's just a caution flag being raised on the track. There's nothing major, but let's just kind of slow down and take a look at what's going on instead of racing around. And Jamie Dimon's pissed off. He has to drop his buybacks. That was a big problem for his stock yesterday. But the fact of the matter is that they're going to build loan loss reserves into the fact that they're thinking that long term, the next year or so, we're going to see higher unemployment rates and loans are going to go bad. A lot of people took out excess loans and, they're going to start doing that, and that is going to crimp some of their profitability. That's what happened. What happened a year ago is they released the loan loss reserves, and that bumped up their earnings substantially. Now, that didn't help the stocks too much, but over the last year, there's a reality that eventually you may have to bump that back up to make sure they have enough money to protect themselves in the event of a downturn, which is what we're seeing right now, and that's what's going on with the banks. You want to probably stay away from some of the big boys right now. I mean, I favor a Citi to a point, Bank of America. Let's see what we're doing. Let's see what Citi is this morning. Citi came out with their earnings. Citi's up 5% in the pre-market right now. Bank of America up 1.39. Wells Fargo yesterday out, down a bit, not doing so well. Goldman Sachs wasn't doing well yesterday, up a little bit, dropping down to 52-week lows though right now. So when you look at Citi though, Citi looks pretty awful. They all look awful. There's no question about this. I mean, look at PNC. Pretty much the same across the board of what's going on there. Okay, but this penguin-style action is what's going on right now. The support and resistance, I think right now what you have to really watch for, and I mentioned this in the chat that we saw earlier, is the fact that there was a significant amount, first of all, there's a significant amount of negativity. And when you have the VIX as high as it is right now and volatility as it is, where you have the futures up almost 1% to start the day, who knows where they're going? Futures were down on the Dow Jones 600 points yesterday at one point, rallied all the way back up and only finished down slightly on the day. Same thing with the Qs, down a couple hundred points on the Qs, 2% to finish pretty much flat yesterday. That's a big range overall. And I think that one of the important things that you need to consider as traders, not as investors now, as traders, is you need to watch your exposure, your shares, your outlay. So if you're used to doing 5 futures contracts on whatever, let's say the S&P 500, maybe you want to start thinking about 2. The volatility will kick you out if you're not careful, if you set up specific stops on that and you're not using the right time range. But every day we're seeing this weakness to strength, strength to weakness. And, we're looking at some of the areas right now when you want to find beaten up names, particularly in tech and biotech, and some areas in retail that have been beaten up and obliterated, which are showing basing patterns. You want to see a basing pattern? Who wants to see a basing pattern? Here's a basing pattern. It's ugly. But Target dropped off a cliff, right? And now what we could do is we use our tools that we have just to draw things so we can see where we are. We're seeing a basic, well, actually, I'm going to drop this down. Look at that thin range that we're showing right now on Target. Now, Target has the opportunity, of course, to start moving lower. Right now, it's banging along the bottom. But, if we can clear this area about 148 and change, we'll call it about 148 and a half, right about there. You have the opportunity to get to about 153 and about 159 on a trade. That's not so terrible. Now, it's a high-price stock for some traders, over $100. But I will tell you that it's something to consider, just something to look at as some of these things are starting to bounce up. Also, you look at a company like a Roblox, terrible chart. But look at that, double bottom, basing pattern, moving above, up. We talked about these lines before. Look, we got right to that line that I drew in a couple weeks back, 44.08. Drew that in, hit perfectly, and returned. Up about 2% in the pre-markets at 38.28, right about here. It's got to kind of clear this area to get somewhere. What's another one I wrote about? Oh, Affirm. These are some crazy names that are showing basing patterns, right? We're seeing basing patterns here, not able to get below a certain area. That's your out. Your automatic out level, and that's important. Okay, economic data, we saw this. CPI was hot. Employment's still working and still strong overall, although we are at a multi-month high on initial claims. I thought that was interesting. Housing starts are starting to weaken. Housing overall is starting to weaken. That's important to look at. And commodity inflation has turned to deflation. So look at, I don't know if you've watched this, but look at, this is copper. It's copper. I mean, I don't know, got to go back to here. 11/23 of 2000, or even less than that. Here, November of 2000. We basically just gave back everything in this area. Now, crude's a different story. We know that, right? But look how much we did get back. These are some lines we drew in here also. This 92. See, we cut below that yesterday. Yesterday was at 90 and a half at one point, trading about 97 right now. But did get down to this level, broke through its key level of, I would call it about 92 and a half. Didn't get back down to 88, but I'll tell you something. That's in the cards if it can't stay above here. Right now, we do see some consolidation, but this move from about 124, I think it was, at the peak, maybe 121 on the intraday, on the daily. But we saw this down to, we're talking 30 points on crude. Pretty impressive moves overall. All right, let's get into the talk about what we're going to talk about today. And of course, in the chat here, which now everybody can seemingly use, you can put your names there, names of or symbols of stocks that you want me to take a look at. I find it's very interesting that right here in our radar screen, there's a lot of blanks here, meaning that we're not seeing a lot of biases, short or long, on the shorter term 30 to 60. Kind of interesting. We also seeing that yields at 2.963. Really couldn't get the yields up, even though they think there's a 75 to 100 basis point increase happening. We can't get yields over 3. What's that about? All right, here's a question. If somebody's asking me, if the Fed continues to increase rates in July and September, while other countries cannot keep up, as you stated, wouldn't the USD go higher? So I think the answer to that question is yes and no. Yes, the USD should go higher, the US dollar. However, I think some of that is baked in already. I think the reality is that we know we're going to, because everybody knows this. Is there any surprises right now? Everything's been telegraphed so well that I just can't imagine that we're going to see a substantial surprise. Even if you go 100 basis points next meeting, no longer is it a surprise. Therefore, it's priced in. And I think the USD is getting towards, not absolute, but towards its peak area. And I think that we're seeing that has been working for the idea of dropping commodity prices, and the Fed likes that. So could it go higher? Yes. Will it go higher? I think the basket is pretty much set at this point. I think that a lot of things are baked in. Surprises aside, I think everything that we know that is currently priced into this whole situation. Let's talk about the bonds. This is a bond yield. Notice that even with the idea that we saw the other day of a 100 basis point number, can't get above it. We put this line in right about 3%. This is knocking above that or right at it a few times and flew down. Look at this. There's divergence on the downside. We're seeing that the weakness in yields. Talked about crude a second ago. This is interesting. In a market that has been punishing just about everything out there, what's been working? What's been actually working? And what's been working is biotechs, healthcare to a lesser degree. We're talking about going from 63 to 63.50, right? Is that what it was? 63.50, right about here, right? To 84. This is what we're talking about when markets just got obliterated. This has come down already. But again, we got a consolidation here. The consolidation broke and we went higher. That's what we're looking for. Consolidation in a range and the break. And where's the break go? The continuation. Now, it could have just as easily gone here, but it didn't. My point is, this is an area to look at. And there's a variety of different names in here. Edit. It's up 4.5% today. Look at this. Again, a basing pattern. Picked this up recently. CRISPR. Look at that. Look at that. And we're talking about a low back in May of 45, now at 81. Hello. Now, long term, what are we seeing? 110 is a level on the upside that is of interest. Right now, we have probably 83. You get through there, you're going to be getting towards the 90s pretty quickly on this. See, I talked about this 100 times with you, and I said, hey, you know what? Watch this gigantic range right here. This is a monkeypox with a company called EBS. These are two. EBS doesn't look so strong. This is interesting. I watch this for breakout, breakdown. You get to that 1334 level. 1315. Give you the exact number here. 1324 is our level. Just hover over, and you can see, right? So we just take a hover. We hover, and it says, okay, hey, where's the lift? 1324. See on the bottom right there? Cruise at 1011. That's the high volume node, the point of control. The stall or the unfair low at 8.54. Huge range. Just a huge range in between here. But, and when you break down, you could definitely see this come back down at 10 or so, but it's holding up pretty nicely here. Something to watch on a breakdown reversal. I don't know if I'd pick it up at these levels. JP Morgan, we talked about this. Hey, anybody see anything good here? It's exciting. I don't see it. Citigroup coming up. You know, if you, wow, Citigroup is down a lot, right? Yeah, oh yeah, but wow, look at it come up. It's $44 a share. Do you know? Let's take a look at this. This is pretty scary. Citigroup, after its reverse split, is down here. This thing lost so much money from 554. This is a reverse split all the way down to where it is now. This is back in 2007, 2008, of course. But it was 550. It's still 90% off of its high from 2007. 2007. Still 90% off its high. How crazy is that? Now, of course, I'm using daily here. I talk to you about this all the time. You can use 60-minute, 30-minute, 15-minute, whatever. Here we have the radars. If you look at this and you look at what's going on this chart, what you'll see is you have these radars. This is more of a granular view. A lot of people like to use these because you get some additional detail, some high volume nodes that you can be watching for that are even more refined than what we have right now. Nothing's showing up right here that looks any good. I mean, right here, we can go backwards and see here. There's a level of, let's see if I can draw a straight line, which I don't think I can. Right there. That's a little bit low. Right about here. So, you know, I wouldn't be surprised if you come into this level here. Okay, that's that. I'm drawing a straight line. Can't take it. There you go. 42 and change. Give or take a couple of pennies right there. 42.62. Interesting. Bank of America up 1.73. Reports next week. Also been suffering. What are we doing with Twitter? A couple of interesting comments about this recently. Going to trial. Are they going to be forced to actually do something here? I don't know. Maybe. Is Musk going to have to buy it? It's very strange. Taiwan Semiconductor, seeing a nice pop here yesterday after some good earnings. Interesting. You can see a pop. If things go well, I would expect this to be from the 83 level, probably back up to our 89 level, if we could see this reversal continue on the right here on the daily chart. It's been a terrible number of months from 140, but these are some of the beaten ups. You got some consolidation, base forming here, but not a lot. Qualcomm also hit it nicely yesterday. A lot of area to get through. You have to really look at this and mark this above 145. 145, you have some clearing up to about 154. The SMH holding, this is the ETF that has semiconductors, holding on pretty well here, turning around a bit. And the Qs, again, 289 or so. We did tap this bottom level a couple different times here. Right now, it looks like that's about the range. One of the things you'll notice here, very important, there's no green, right? All these other ones have green, blue, red, green, blue, red, green, blue, red, blue, red. Where is it? It's hiding underneath this blue, meaning the support level, and we'll bring this down here. Support level right there. 276.92 is pretty solid. Off to the races, doing pretty good. We'll have this up on our YouTube channel very shortly and over on TriggerCharts.com. Like I said, if you want to be, even if you text it, put me in the chat. If you want to be a beta tester, it's or at least a first line. I guess the beta test is a bad word. A first line tester of the new product. Send me an email, support@TriggerCharts.com, and just say, hey, I want to test out the new program. I want to be there on the first. Thanks so much for being here. I'll see you again next week. Actually, I'm not going to see you next week. Wait, not going to see you next week. Next week's going to be canceled due to priority vacation that's happening. We'll be there 2 weeks. Thanks.